G. Shiv Kumar, Executive Director and CFO of G Shipping, joins us now. And let's connect with him to understand that what is the big picture in the entire shipping space and why freight rates of late have had a lower bias. Good morning. Thank you for joining us. Freight rates of late have had a downward bias. We all thought that things would normalize after that Red Sea crisis, but directionally things have not been, I won't use the word stable, but they certainly have not been very encouraging. Why is that?
Yeah, morning, Nikunj. Thanks for having me. Yes, I take it you're referring to tanker freight rates, and tanker freight rates have been disappointing over the past 3 months or so, where we've had, and the main reason for that is really poor demand. And starting with poor commodity demand growth itself, we've seen China, especially on transportation fuels, which is petrol and diesel, demand has been, growth has been negative in China, in the EU, and in the US. This is in the first 10 or 11 months of calendar 24. So that's the issue really that the tanker market is facing. Yes, the Red Sea had a strong positive impact in the first half of 2024, but the market has adjusted to it. What has also happened is that the arbitrage between the East and the West in oil prices has sort of gone away. That used to be a contributor to a demand for tankers to take advantage of the arbitrage. So traders used to do that. Now that it's too expensive to move from East to West, you have to go all the way around Africa. Now that it's too expensive, that arbitrage play is gone. So oil is staying in the respective basins. And therefore, that on the margin, those cargoes have got removed. So the East-West and West-East have got removed from trades, have got removed from the market. And that's the issue that the tanker market has been facing. As I said, of course, oil demand growth also has been quite disappointing this year.
And given how alternate fuel sources are getting now created, which is whether it is solar, whether it is nuclear, whether it is wind, the demand for oil is unlikely to come back. So can one say that the demand for oil tanker would remain subdued?
I don't think we should draw a conclusion from 1 year's data. I think it's more global macro or regional macro which is affecting it. So let's just take one example, right? So the country with the highest EV sales, or a major country with highest EV sales, is China, with close to 50% of the new cars sold being EVs. That still leaves you with 50% internal combustion engine vehicles getting added to the fleet, which means that demand should be still at least a small positive. So it's not yet until you get to close to 100% EV penetration, where almost 100% of new vehicle sales are EVs, that will not really go. And nuclear and everything else is for generation of power, which is a threat to coal, which is a different commodity and also a commodity of importance to us as a bulk carrier company. But as it stands, it's not really a threat. You're still seeing coal demand grow and steam coal demand growing, albeit a little slowly, but it's still positive.
Fair enough. I just wanted to understand a little bit more, Morning, as to whether or not you would be able to sort of quantify the impact on financials for Q3 with respect to the freight rates hopefully recovering, and what kind of an impact are you looking at and how are you navigating the company's strategy amidst these rates?
Morning, Avan. The impact, I won't quantify the impact on the financials. All I'll say for perspective is that we're about the spot market, that is Q4 Cal 24 over Q4 Cal 23, is probably down by about $10,000 to $15,000 a day, depending on the type of ship. For the tankers, for the bulk carriers, there's not much change. For the LPG ships, the rates, the spot market doesn't matter because we are on time charter for all our vessels. So on average, $10,000 to $15,000 a day for the product tankers and crude tankers in the spot market is the impact. Again, these have leads and lags. This depends on how much of our fleet is on time charter, etc., which is on fixed rates. But that's sort of the indication of what's happening in the spot market currently. And as to your second question on how we navigate the situation, we've been preparing for this, and you know that we've been collecting cash over the last 2.5 years. We are now heavily net cash. We've been waiting for opportunities to invest. If there's a market correction and it leads to prices of ships coming down significantly, then we are there to invest, because we haven't grown for the last 4-5 years, and we've been preparing ourselves for the cyclical downturn, and we'll be happy to go out and buy ships and build up our capacity again. So currently we have about $450 to $500 million net cash in Great Eastern Shipping itself, standalone.
Sure. So you have enough war chests, but where would you look at deploying that? Are you looking at perhaps just increasing your field when it comes to the, the crude market, or you're looking at the bulk segment to add it? Or what about containers? Because you haven't forayed into that, yet, but you have been looking for opportunities. Is it finally happening now?
It depends on the price. We are quite agnostic to which sector we invest in. Wherever we find best value is where we will invest. So currently, we are not yet seeing that value. It's moving at least in the right direction. We've had a correction in tanker prices, maybe 10 to 15% over the last 3 months. Dry bulk also similar. Containers, not as liquid a market, so you can't tell, but it might be down a bit. So we're okay with any of those sectors, really. Wherever we get the best deals, we'll be there to buy.
At the best yields, agnostic within the segment, but wanted to get a better sense from you with all of these commentary coming in from US President-elect Donald Trump, whether it's about Panama, whether it's about how he's looking at impacting the trade globally with respect to tariffs. How are you bracing yourself for it?
We can't do anything really about this. This is our customers who are the traders who are moving commodities all across the world, are those who will be affected. This will lead to, sometimes strange arbitrages which happen when these tariffs come into play, and some strange trade patterns can happen as well. So the way we prepare for all of these markets, and it doesn't matter what factors really swing the markets. For a positive market, we are positioned with a big spot fleet. For a weak market, we are positioned with significant capex capability. And that's always been the principles under which we operate. So we are okay with whatever happens to the market, really.
Can you explain the dynamics to us in terms of what the total new capacity addition at global level could be for the shipping industry? Where do you see demand moving higher? Because it's a cycle. We all know that. It's not for the first time we've debated the cycle. So are we in that period of excess capacity where it will take 2 years before things change, or are we 6 months away from excess capacity getting absorbed? Where are we?
So the one thing which has happened, and this is something which we think about all the time, so thanks for asking. The one thing which has happened this time with regard to the shipping market, especially the commodity shipping markets, is that the order book hasn't built up, which is the pipeline of new ships joining the fleet, hasn't built up like it usually does in a very strong market. So the tanker order book, while it has doubled in the last 12 months or so, is still around the 15% mark, not more than that. And on the flip side, you have a very old fleet, a very significant proportion of old fleet which needs to be removed at some point. Those ships have survived so far because the market is very strong, and any ship that can float and that can carry cargo has demand and is making decent money. But when the markets turn weak, which can happen when new ships come in, the older ships will have trouble with their employment, will face negative cash flows potentially, and therefore those ships can get removed. So yes, in the short term, if demand doesn't pick up, you could have new ships joining the fleet and depressing rates. But over a longer period of time, this market adjusts itself through scrapping by old ships getting removed from the fleet. And that's something which will give over a longer period of time, over a 1 to 2 year period of time, give a little bit of a floor to rates.
Okay. So if China does not come back, we don't know, because so far the 3 stimulus packages have not worked, and you mentioned this in your opening part about the China demand. What kind of swing it could create if it comes back, if it does not come back?
If it comes back, it's a big positive. And the thing with tanker markets is that it goes from ships earning $10,000 a day to ships earning $50,000 a day in a week when suddenly demand comes back. And also the other way around, when demand suddenly drops off. So China is a huge player in commodities, much larger in dry bulk than in oil. But even in oil, Chinese demand not coming back or China not growing is a significant negative for the tanker market. So one has to be worried about a situation where China doesn't come back, if it doesn't come back with oil demand growth. We are hoping that it's a temporary blip, but let's see. It's always difficult to tell. But in the meantime, Chinese iron ore imports have been fine. Chinese coal imports have been fine. Bauxite imports have been pretty strong. So dry bulk wise, China has not been doing badly. It's only the tanker demand which has got affected here.
So bulk is not as bad. It's only the tanker demand which is a bit sluggish. Thanks for making time and speaking with us today.
If you like this video, then like, share and subscribe to ET Now.